Recently, I've been helping more clients use below market value bridging, which is essentially a creative finance strategy that helps you recycle capital faster and maximize leverage. And my brokerage, Futurity Finance, we've actually got access to exclusive terms you won't find elsewhere in the marketplace, thanks to our in-house surveying expertise and lending volume we handle. So today, I want to break down what below market value and bridging actually is, how it works, and why it's such a powerful tool for investors who want to scale efficiently. So what does bridging against market value actually mean? So with most standard loans, whether residential, buy-to-let or bridging, lenders will only lend up to 75% of the purchase price. So let's say you're buying a property for £100,000, but its true market value is £150,000. Most lenders still base the loan on the 100,000, which means you'd need to put down a 25% deposit, even though the deal already has built-in equity. So bridging against market value changes that. So here the loan is based on the percentage of the market value, not just the price you're paying. And that instantly boosts your capital efficiency. So for the right deal, I can arrange facilities up to 75% of the market value, serviced at 0.95 per month with no exit fees, okay? And that structure is designed to give investors a higher day one net position and stronger capital rotation. So here's what it looks like in numbers, okay? If you're buying a property, let's say 100,000 and the market value is 150,000 and a loan at 75% of that market value gives you 112,500. That could in theory, okay, cover the entire purchase price and even leave a small buffer for fees or interest. Now, one important caveat, some lenders won't allow 100% of the purchase price to be covered. They might cap it at 90% of the purchase just to make sure you've got skin in the game. Even then, the difference is significant. Instead of putting in, let's say 25%, you might only need around 10% of the purchase price, and that can halve your cash required and help you scale much faster. So where does this strategy really shine? For me, okay, it works best for probate and off-market deals, distressed or motivated vendor situations, and genuine below market value acquisitions. And when you can evidence the discount, market value bridging lets you recycle your capital faster and build momentum into your portfolio. Let's talk about valuations because this part is critical. Rule 1, don't disclose the purchase price. Market value bridging relies on the valuer's independent opinion, okay? And if they know what you're paying, they'll often default to that figure, which undermines the strategy entirely. Rule 2, work with lenders who instruct valuers correctly. Reputable funders don't share the purchase price with valuers, but make sure your agent, vendor, and solicitor don't either. Next, let's cover refinancing off the bridge. So most investors worry about exit, but many buy-to-let lenders also lend up to 75% of the market value. A common route is to take out a 6-month bridge to establish ownership, okay? Then refinance at 75% market value with the buy-to-let mortgage. And if your bridge carries, let's say, an exit fee, your payoff might be slightly above that 75% loan to value. But if you've added value or your property is appreciated, you might even pull some cash back out. When you brief your broker, make sure to be upfront about your position and let them know your cash input, whether that's 10, 15 or a maximum leverage position. Specify that you want a market value bridge and not a purchase price only. And make sure no one involved discloses the purchase price and clarify your exit plan and timeframe. So the key takeaways, you're borrowed against the true market value, not the discounted purchase price, and you can often reduce your deposit, sometimes from 25% down to around 10%. I'd say always keep your purchase price confidential and plan your exit early. You can usually refinance or make a sale after around 6 months. Right now, I'm supporting a high volume of below market value bridging deals, securing exclusive 75% market value terms that aren't widely available elsewhere. And that's possible because of our lending volume, our in-house risk surveying expertise, and our strong relationships with funders. So if you want to maximize your capital efficiency and access some of the best below market value bridging terms, reach out. I'll be more than happy to help you structure the deal right from day one.